Principles, or GAAP, requires us to use accrual accounting, the need to make adjusting journal entries arises. You may recall that accrual accounting means that we recognize revenues when realized or realizable and earned, and we match expenses to the revenues that they help to produce. Sometimes, though, we receive cash before performing our revenue earning activities, and sometimes we receive it afterwards. Similarly, we sometimes pay expenses in advance, and sometimes we incur expenses before we pay for them. In accounting terms, this means that we sometimes accrue revenues and expenses, and sometimes experience deferred revenues and expenses. A simple way to memorize the meaning of accruals and deferrals is that accrual events involve action first and dollars later, whereas deferral events involve dollars first and action later. It is these accrual and deferral events that cause the need for adjusting journal entries. This slide shows some ways in which accrued revenues occur. Notice that all these examples illustrate situations in which the revenue earning process is complete but the cash is not yet received. It's quite possible that these revenue items will remain unrecorded during the accounting period because no event occurs to prompt the recording. So if we don't make adjusting journal entries, they'll be excluded from the financial statements. Using double entry accounting, the journal entry to record each of these revenue earning events will involve a debit to a receivable, or IOU from our customer, and a credit to a revenue account. Here's how we make the adjusting journal entries for the three previous examples. Notice that in each case we debit a receivable account and credit a corresponding revenue account. Failure to make these adjustments at the end of the accounting period would result in an understatement of revenues, net income, retained earnings, and equity, and an understatement of assets, namely receivables. Here are some ways in which expenses can be accrued. Notice that in all these cases, expenses are incurred that should be matched with current revenue. Again, it is likely that no expense has been recorded during the accounting cycle for these events, so we will need to make adjusting journal entries instead. Here's how we make the adjusting journal entries to record the accrued expenses for the three previous examples. Notice that in each case we debit an expense and credit a corresponding payable to show that we owe payment for these items. If we omit to make this adjustment, our expenses and liabilities will be understated, and our net income, retained earnings, and equity will be overstated. Here are some ways in which businesses might receive cash that they have not yet earned. Recall that using accrual accounting, the revenue recognition principle disallows us from recording revenue until it is earned. Since there has been a cash receipt, this must be recorded. The corresponding credit is to a liability that shows an obligation to provide goods or services in the future. When some or all of this revenue becomes earned, an adjusting journal entry will be made to reflect that fact. This first journal entry shows the receipt of cash for future delivery of goods or services. This is not an adjusting entry, but is recorded at the time of the cash receipt. The second journal entry shows the adjusting entry to recognize that some or all of the revenue has become earned. Notice that the adjusting entry serves to transfer amounts from the unearned revenue account to the earned revenue account. If we omit this adjusting entry, liabilities will be overstated, and revenue, net income, retained earnings, and equity will be understated. Here are some examples of how businesses might pay in advance for future expense items. Recall that under accrual accounting, the matching principle requires that we match expenses to the revenues that they help to produce, instead of just recording them currently. This slide shows that as soon as we have made a cash outlay for a future expense item, we record the payment at that time with a credit to cash. The corresponding debit is made to a prepaid expense account, which is an asset account. This entry is not an adjusting journal entry, but is simply made at the time at which we make the cash outlay. As the asset becomes used up or expires, it is important that we make an adjusting journal entry to show the reduction in the balance of the prepaid expense and that some expense has now been incurred. If we fail to make this adjusting journal entry, assets, net income, retained earnings and equity will be overstated, and expenses will be understated. The purchase of productive assets, such as factories, machines and business vehicles, is also a type of prepaid expense, in that the purchase occurs first, followed by a systematic and rational allocation of the cost into expense over time. The name for this expense is depreciation expense. One overwhelming matter of importance on this topic is that the objective of the depreciation process is to match the cost of these productive assets to the revenue that they help to generate. Our systematic and rational method of cost allocation will reflect the fact that different productive assets have different useful lives and that they contribute to revenue production in different patterns over time. Let's look at an example of a fixed asset purchase and subsequent allocation of its cost into expense using the process of depreciation. In this first journal entry, a fixed asset is purchased for $1,100 cash. The asset is expected to have a useful life of 4 years and an estimated salvage value of $100 at the end of 4 years. The second journal entry shows the annual adjusting journal entry to record depreciation expense of $250. The calculations are shown on the next slide. To calculate 1 full year of depreciation expense on this asset, we deduct the estimated salvage value from the historical cost of the asset and divide by the expected number of years useful life. Salvage value is our estimate of the amount that we could exchange the asset for when we're finished with it. The expected useful life is our estimate of the time period during which we anticipate that the asset will help us to generate revenue satisfactorily. As you can see, the calculated depreciation expense is $250 for each full year. This method of calculating depreciation expense is called the straight line method and allocates the cost of the asset into expense evenly over time. Much of the time, productive assets are not put into use on the first day of the accounting year, so the first and last years of the asset's life will show partial year amounts. For example, if this asset were placed into service on June 30th, only $125 of depreciation expense would be recorded on the financial statements for the first calendar year of its use. For years 2 through 4, the expense will be $250 each year, and for the 5th year the expense will once again be $125. The purchase of supplies used in our business is also a prepaid expense. Examples of supplies include paper clips, paper, toner, pens, pencils, staples, and other items that will be used up incidentally to our business activity. In the real world, these items may be immaterial in cost, so the actual treatment may be different to what I'm about to describe here. Nevertheless, when studying accounting, it's always preferable to learn the theoretically correct treatment. When we purchase supply items for the business, we debit an account called supplies at cost. This is an asset account. In the case of a cash purchase, the corresponding credit is made to cash. You may also hear the supplies account referred to as supplies inventory, which is perfectly correct, but don't get it confused with merchandise inventory for sale in the normal course of business. As we use up the supplies, we need to be sure to debit supplies expense, an expense account, and credit supplies, the asset account, to reflect the fact that our stock of supplies has declined. This is usually done as an adjusting journal entry at the end of the accounting period and simultaneously records the supplies expense. Should we fail to make this adjusting entry, expenses will be understated and assets, net income, retained earnings and equity will be overstated. Be sure to note the difference between these similar sounding accounts. Supplies or supplies inventory is the asset account which measures the quantity of supplies on hand. Supplies expense is the expense account which measures the quantity of supplies consumed during the accounting period. Recall that trial balances are tools used in manual accounting information systems to help us to periodically verify that our cumulative debit entries to our accounts equals our cumulative credit entries. By physically listing our debit account balances and our credit account balances and finding their respective totals, it is relatively easy to check that they are equal, or should I say, they balance. While we may list trial balances at any point during the manual accounting process to check on our progress, it is also typical in a manual accounting information system to perform a trial balance after making our final adjusting journal entry of the accounting period. This trial balance is called an adjusted trial balance. Adjusted trial balances have the same limitations that we discussed earlier relating to trial balances. In manual accounting information systems, we use the account totals on our adjusted trial balance to construct our financial statements. It is typical to start by building the income statement using the revenue, expense, gain and loss accounts. Having calculated net income, it is possible to construct a statement of changes in owner's equity. We take the beginning balance in owner's equity from last period's balance sheet or statement of changes in owner's equity. The balance sheet is prepared from the permanent accounts on the adjusted trial balance. Finally, the statement of cash flows is prepared from the cash balance on the adjusted trial balance. This is the ending balance. We take the beginning balance from last period's balance sheet or statement of cash flows. We also need detailed information about the type of cash flows that occurred. Notice that the ending cash balance on our balance sheet and statement of cash flows must be the same because they both measure the same thing. At the end of the accounting cycle, we like to empty our temporary accounts so that we can start counting at zero again in the following year. Some accounting texts will show you how to close these balances into an account called income summary, and this method is illustrated here. The end of period balances in the revenues accounts will show credit balances, so these accounts must be debited to close them out. This is shown in the first journal entry and results in an increase in the income summary account. The end of period balances in the expenses account will show debit balances, so these accounts must be credited to close them out. This is shown in the second journal entry and results in a decrease in the income summary account. Notice that after we've made our closing entries into the income summary account, its balance will equal our net income for the year. Subsequently, the income summary account is closed into retained earnings. This increases retained earnings if the company has made a profit, and this is shown in the third journal entry. Finally, the debit balance in the dividends declared account is credited, and the corresponding debit is made to retained earnings. This reduces retained earnings by the amount of dividends declared during the accounting period. Other accounting texts will show you how to close these balances directly into the retained earnings account, and this method is illustrated here. Both methods are equally correct and nowadays reflect nothing more than different teaching methods, since most accounting systems in use today are computerized. A post-closing trial balance is a trial balance performed after the closing journal entries have been made. Consequently, balances will only appear in the permanent accounts. This is because the temporary accounts have been emptied in the closing process. That completes the activities in the accounting cycle. Now we start the whole process over for the next accounting period.